Looking for a dime. James Locke in the house, gonna help you shine.
Hello everyone, and welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. So, first question is from Jeff. He asks, if the economy is slowing down, then why is the stock market at a record high? All right, Jeff, that is a great question. And the answer is because the stock market is forward-looking. As much as 9 months, maybe even 18 months out in some cases, when the market is looking ahead, it's primarily reacting to two key factors: corporate earning projections and the direction of interest rates. On the earnings front, this past quarter's results have actually been quite favorable for many companies despite the slowing economic growth. Consumer sentiment, spending have remained resilient. So the market is kind of pricing in expectations that profits can continue growing, at least for the foreseeable future, as long as that earnings outlook remains positive. It can kind of buoy stock valuations. Now, the other major driver is the trajectory of interest rates and their impact on financial asset valuations. We know that when interest rates rise, it decreases the present value of future cash flows, thereby reducing the value of income investments like stocks and bonds. Conversely, when rates decline, those same assets become more valuable. So right now, consensus seems to be that the Federal Reserve is nearing the end of its rate hike cycle. So the market is forward looking to the point where it expects rate cuts on the horizon as economic growth moderates. So that anticipated loosening of monetary policy is being viewed as a positive catalyst for risk assets like equities. So in essence, lingering earnings growth optimism combined with growing expectations for a dovish pivot by the Fed have provided the fuel to propel stocks higher even amid slowing GDP numbers. The market is trading on the prospects of what it sees coming over the next 6 to 18 months, not just reacting to current data releases. However, your point is well taken about potential rotations within the market once the rate cuts actually begin to materialize. We could very likely see a reversal in leadership with some of the higher flying growth and tech names cooling off. Money may start rotating towards more affordable income-oriented names and sectors if easy money returns. So dividend stocks, REITs, utilities, other high-flying areas could take the leadership baton from growth if the investing backdrop pivots towards a lower rate, slower growth environment. Income investments become relatively more attractive as rates decline. So while the headline GDP and economic figures may seem disconnected from record high equity indexes today, the market is simply looking out further on the horizon. Its pricing mechanism attempts to stay ahead of the curve on the next stages of the economic cycle. But you're absolutely right, Jeff, that any upheaval or surprise in the expected earnings or monetary policy paths could absolutely trigger a sharp sentiment reversal and leadership rotation among stocks. Monitoring those key market drivers will be crucial for income investors to properly position portfolios for the next phase. These disconnects highlight the importance of diversification. Hey, thanks for the awesome question. Now, if you had a question that you'd like to send in, get your question answered, you can do so by emailing it to poolelock@poolelock.com. Let's move right along. Second question from Greg. He says, you mentioned the interest rates were high. So should I be trying to lock in those higher interest rates now? Again, Greg, another great question. Most likely the answer is yes. If you're retired or close to retirement and you're looking for this money to generate income for you, you should be starting to make that transition to lock in higher interest rates. Now, the good news is you might have a little bit of time left. I don't think it's a rush thing. You don't have to jump right into it immediately because right now you have short-term interest rates that are kind of higher than long-term interest rates in some cases. So you have CDs, one-year CDs that are paying over 5%, whereas a 10-year government bond is under 4.4. So you get paid less for making a long-term commitment. Why? Because right now, everyone's predicting that the average over the next 10 years, on average, rates will be dropping lower. So what's likely to happen is that in the beginning, as the Fed starts lowering short-term rates, but the long-term rates might end up a little bit sticky initially. Because again, at some point, this interest rate curve has to right itself. At some point, long-term rates have to reward investors more than short-term rates. But shortly thereafter, long-term rates will start tracking down with those short-term rates. So a lot of people right now are getting locked into these one-year CDs and treasury bills, and they're excited because they don't have to make a big time commitment. They safely get some interest income, but remember, over the last decade and a half, almost 2 decades really, the average interest rate has been much lower than they are today. And the Fed has signaled they're going to lower rates again from these elevated levels. So when they go back down, eventually, short-term and long-term rates will decline. We know the Fed is not going to raise rates again at this stage after this hiking cycle, or they've at least signaled everything that it's unlikely to do so. So yes, it means that sometime in the coming months is probably a good time, if you haven't done so already, to lock in some of those higher interest rates with things like bonds and preferred stocks. And if you want to take a little bit more risk again, maybe some higher dividend common stocks as well for their income stream. So looking in those higher rates now, locking them in now for your income portfolio can make a lot of sense as you approach or enter retirement before rates potentially decline again in the years ahead. All right, Greg, there is an opportunity there for retirees and near retirees to position for income. Thanks for the awesome question. Now, if you'd like to send in your question, do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. Hey, this is James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.